I'd like to welcome us to the financial reporting class question practice. My name is Ngandalo Joseph, and I'll be your instructor in this class. I want to look at this question called Highwood, and of course Highwood has got a trial balance, as you can see there. Please make reference to your revision kit that I sent you for, Kaplan. The requirements of this question, I would like to focus on A and B and C, of course. We need to prepare the performance statement, which is the profit or loss. We need to prepare the statement of changes in equity. We need to prepare the statement of financial position. But now, the approach I'm going to take is to give you the workings, to give you the explanations, and ask you to revert to me with statements so that we can see where we can make emphasis. That is the way we learn. Once you isolate your mistakes, it will be very hard for you to repeat the same mistakes in the exams. Okay, so we already have a challenge of assessments when we're dealing with these online classes. So the least we can do is to ask you to prepare the statements, of course, after the workings have been given. I don't think that we are asking for too much, but of course, students have got different ways of thinking. So now, this company has got equity shares of 50 cents. This simply means that the company has got twice the value. In terms of shares, the company has got twice that amount. When you divide 50 cents, when you divide 56,000 by 50 cents, you'll be getting a figure that is twice that. I should think that you're okay with that. Okay? I'm going to go to the notes very soon, but let me just run through the trial balance to just help you to understand where we're going. We have got retained earnings, and there's a note that has been given. We have got convertible loans, and this is a financial instrument. These questions are becoming quite popular nowadays, where financial instruments are included as adjusting balances. I'm going to do some works with us so that we can see how to resolve that. We have got the issue of property, and the property is given as land and buildings. The element of land is 25 million initially, and that should not be depreciated, but as we shall see, there is going to be a revaluation. You need to know how to deal with revaluations. Plant and equipment has been given as that number, and the respective depreciation has been given. This tax is on the credit side, meaning that we have got an over provision. This deferred tax that you are seeing in your trial balance is the brought forward deferred tax. I think I showed you the other time how to work out deferred tax. There's what we call inventory, and this inventory is likely to be the closing, okay, because cost of sales has already been given here. All right, if cost of sales is given, the inventory in the trial balance is to be treated as the closing inventory, and I think that we've got a note there. The effect receivables, bank, distribution costs, and so on and so forth. You have been given all these amounts. The loan note, of course, I think it should relate to the convertible loan. We are going to discuss something relating to that. So I'm going to go one step at a time, try to see if we can just work out some of these things. First of all, there's an issue. Equity dividends of 5 cents per share was made in November 2010 and charged to retained earnings. So you need to tell us how much was, you need to tell the examiner how much was actually charged in that case. So let's try it out. Try to do some bit of work. That's not one. Workings. You better get your pen and start writing. So note 1 deals with equity dividends. I'll just write dividends here, and how do we find the dividends that was paid? It's as simple as this. You get the value of shares, which is the first line there. I hope you can see that. Then you divide that by 50 cents, and then you multiply that by the amount that has been given in the first note. I hope that you can see 50 cents there. So let's try to do it. You have got, it's not 50 cents, rather it's 5 cents. Huh? I think I saw 5 cents, yeah. So you have got 56,000 divided by 0.5, that is 50 cents. Then multiplied by 5 cents is as good as $0.05. I hope that you can get same number that I'm getting. Okay, let's just try to do that. Divided by 0.5, and of course whatever you get you must multiply by 5 cents, which is as good as $0.05. Okay, I'm getting a 5.6. I hope that you're getting that too. So the double entry for that 5.6, ladies and gentlemen, is we debit retained earnings, okay, in the statement of changes in equity, okay, in what we call the SOCI. Yes, you need to know how to work out this one. 5.6, and then you credit, and this was correctly done, by the way. You're going to have to credit, was this paid or not? Was paid, yes. So we needed to credit bank or indeed cash. Okay, so you have that figure there. So the account that you need to update, is the statement of changes in equity, and of course you know what it means. Let us proceed. The next item is the issue of the convertible loan. We are told that, and of course this is Highwood, meaning you know, there is a standard there. We are told that 8% of 30 million convertible loan notes were issued on 1st April 2010. And when are we reporting? When you see a date, you want to check when you are reporting. When you are reporting, the date of reporting is normally given on top of your trial balance, 31st March. I hope that you can see that. We did this exactly 1 year ago, because if we're reporting 31st March 2011, then it means that we are actually exactly 1 year away from the reporting dates. Okay, so the 8% 30 million convertible loan note was issued 1st April 2010 at par. Interest is payable in arrears on a yearly basis on 31st March each year. The loan note is redeemable at par on 31st March 2013 or convertible into equity shares at the option of the loan note holders on the basis of 30 equity shares per 100 loan notes. Highwood Finance Director has calculated to issue an equivalent loan without the option to convert, and this would fetch or cost 10% per annum. So what we need to do here is to, you know, treat this one as a convertible loan. That means that it has got a component of equity and a component of debt. We need to separate the two. So write note 2. Okay, let me write that one. I think I'll write it here. 2 convertible loan. Okay. Okay, so we need to, the key issue here is to separate debt from equity, and then the other thing is to calculate. So 3 things should be done here on this note. Calculate finance cost is as good as interest, and then calculate what we may call the loan note, not CV, and then also calculate equity component. So about 4 things are coming out of this particular note. So I'm going to have to deal with this for your sake. So how do we deal with it? Let's try to work it out and see what is taking place here. Okay. Right, so I'm going to just do some kind of a table here so that we can see what is going on. Right, so this is what you're supposed to do in the exams. So you're going to check for the year, then you get cash flow, and then you get your discount factor, DF, and then you have your PV. Okay, now in most cases the discount factor is given, and we normally use the higher rate. So when you look at this question, between 8% and 10%, the higher rate is 10. We want to discount these cash flows at that rate. Okay, so this is interesting. I'll just put it there at 10%, all right? And I'm going to push all these numbers on the other side so that you can follow through. So regarding the issue of years, I think it should be clear here. We are told that these convertible loans were issued on 1st April 2010, and they are likely to be, converted at the option of the loan holder in 2013, and this will be after 3 years. So from 2010 to 2013, you've got 3 years. So you're going to have to write, 2010. If you want, you can do what I'm doing here. 2011 is 1 year. 2011 to 2010. Wow, to 2012 rather. It is another year. Then 2012 to 2013. It is the 3rd year. Then with regards to the cash flows, so we have to pay attention to the principal amount, 30 million at 8%. So in the first year, we are saying 8% of 30 million will be paid. Okay, and by the way, I have to create some kind of space here. I have to create some space insert here so that we don't have a challenge, with the issue of dollars. And I'm getting to be a little bit lusty here. Maybe it's good for you so that you can follow through. So I'm going to get this, push it there, and push it there. Okay. In the other year as well, we're going to have the same 2.4, but in the last year we're likely to pay the 30 million back plus the same 2.4, so it will be 32,400. Okay, then we have been given the discount factors for the highest percentage, 0.91, 0.83, 0.71. So 0.91, okay, 0.83, I think I saw that, and then 0.75. I'm going to have to increase my decimal places here. Okay, then we do the multiplication, and I think that the multiplication will be as follows: this multiplied by that amount there, we have got that figure, and we do the rest. Okay, those are the figures we have. So the total value of debt is a sum of all these present values. We call that date. Okay, date component of this, but the cash that we received is higher than the date component. We received about 30 million. So the difference, therefore, which is a benefit to the we call it a balancing figure. A benefit to the shareholders is 30,000 minus, all right, so let me just take it back there. Let's do that, minus that figure. Okay, let me go over that one again. 30,000 minus that figure, you're getting that figure. So that difference is what is known as equity. Shareholders received 30,000, but they're only going to pay debt which has got a present value of about 28,476, meaning that they are gaining somehow, and their gain is 1524. Okay, so what are the implications on the financial statements of these? First of all, you will need to find finance cost, and that will be based on the debt figure. Finance cost is going to be equal to 28. Okay, there we go, 28,476 million. I think I can write it there. Then we multiply that by, is that correct? 28,4. Okay, so I think it's correct. Yeah, you can put some stars, multiplied by the higher percentage, which is 10%. Okay, so automatically we just have to move one decimal place and we get our number. That is 848 in terms of thousands. Okay, because we have got thousands of dollars here, if you just round that one off. Okay, that's what we have there. Then in terms of the equity, I think the equity is very easy. This should be included in your equity, in your share capital. The figure that we have found here is your equity. And then in terms of convertible loan amount to be included in our non-current liabilities, we are going to do the following, and you have to listen carefully. We are going to get the same 28,476. We are going to add the effective interest rate, which is 2,848. Then we're going to less the nominal interest rate, which we were finding here. If you can see these numbers, a 2,4. All right, a 2,4. We're going to find our figure to put under non-current liabilities in the financial position as our convertible loan, 476. I want you to ask me questions next time when you get on Zoom with myself. So this is the number that we expect to see in the non-current liabilities. So we are done with note 2. Let us proceed to note 3. And under note 3, there's an issue of property, plant, and equipments. On 1st April 2010, Highwood decided to value its property at its current value. Qualified valuer reported that the market value of the property on this date was 80 million, of which 30 related to land, meaning that 50 million relates to buildings. So we depreciate 50 million. At this date, the remaining estimated life of the property, the building, is 20 years. Highwood does not make a transfer to retained earnings in respect of excess depreciation, so you are lucky on the revaluation of its assets. Plant is depreciated at 20% per annum on a reducing balance method, or depreciation of non-current assets is charged to cost of sales. Very good. So we're going to do this note, it's not what? Note 3, non-current assets. Okay, I hope you can see that. Let's do some bit of work here, and is the students, I hope that they're following through on the other side. You want to ask questions, of course, where you feel that things are not clear. So I'm going to do some bit of work here for our non-current assets, and I'm going to ask us to complete the question. Okay? Wow. Let me get my number there, put it here, and I want to start now with the issue of property. So as we have rightly heard, property has been revalued, and it's now 80 million. We want to depreciate this property. Depreciation will be based on the value of buildings in the property, and of course that is 50,000 divided by about 20 there. So we are getting a 2.5, and of course this 2.5 is supposed to be a minus. Okay, so you put minus 2.5. So your CV, your property CV, is standing at the difference between those two figures is 77,500. This is a CV of property. Okay, and then we have got plant and equipment. We have been given plant and equipment. What is the rule? The rule for plant and equipment in most cases is that it should be depreciated at reducing balance. You can see, of course, 20% reducing balance. So what we're going to do is we're going to get onto our trial balance and find the CV of this plant at inception. So the CV of this plant at inception, was, let's try to check. I want you to check the CV of the plant at inception. It was, maybe I can go there for the sake of those who are going to be asking, where is the figure? Okay, this is the figure there, and then we have got our depreciation there. So I am now going back to my board. We have got 74,500 minus 24,500, and then we multiply everything by 20%. Not now. Okay, we're going to first find the CV. Okay, minus 24,500. I've got that number. Then we say depreciation will be equal to the same difference, 50,000 multiplied by 20%. 20% is 0.2, please. How much do you have? 20,000, 50,000 rather by 20%. You've got a 10,000 there, meaning we can say minus 10 here, and I think that will be safe. So let's do the minusing. We have got a 40 there. So what does this mean? This simply means one thing for your property, plant and equipment in the statement of financial position. Please, I want to see this number here, the sum total of these two numbers. We have got, so let me just drop this one so that it looks a little bit, better. We have got this number plus that number there. So the sum total, what we want to see in your property, plant and equipment, as far as property, plant and equipment is concerned, is 117. Okay, following the format. Okay, let us proceed. What else need we to do? Okay, so I think now I can go to my cost of sales, because the other issues you can do. So this is now going to be called, finally, working one. Cost of what? Cost of sales. Okay, our cost of sales is given there. In the trial balance, please check your trial balance. I sent you the revision kit, So you need to be counter checking against what I'm doing. In the trial balance, the cost of sales is showing at this one. I think this is the one, 207,750. Okay, so we can go there, 207,750. All right, then we have got an issue of depreciation. We are told that all depreciation must be treated as cost of sales. Okay, so is the depreciation for buildings, if I may put it that way, and I think that's more accurate. It's got a 2.5, and then we've got plant and equipment. Okay, it's got a 10,000. I think I remember that. It's got a 10,000. Okay, there we go. Then there's the issue of closing inventory being misstarted. So we need to do some closing inventory adjustment. Okay, adjustment. I think I'm taking too much time, although somebody might be saying you need to do more, but I will need to end very soon. So closing inventory adjustment, I'd like to refer you to a note. You see the closing inventory here was 36, but when we go down there's a note which speaks about something that is a little bit different. We are told that inventory was not counted until, in note 5 please, was not counted until 4th April due to operational reasons. At this date, its valued cost was 36 million, and this figure has been used in the cost of sales calculation above. Between the year end of 31st March 2011 and that, Highwood received delivery of goods at a cost of that much, 2.5, and made sales of 2.7. Okay, the markup of that much. So we need to find the correct figure for closing inventory, because some goods came in and some goods were sold. So what we need to do is to add back, if I may suggest that, what was we're going to less what was sold. We're doing a review here. Less what was sold, and then we're going to add what was brought in, so that we can restate the figure of inventory, because it is not actually true that that's a number. So I'm going just to do a side working here to show you what I mean. The figure in the trial balance is that much, but the company bought, if you may, inventory with 2.7, so that one you less, and they sold inventory that had a selling price of 7/8 at a markup of 30%. So we need to deflate this figure, bring it back, this figure here, bring it back to cost. So if you do that, you're going to have to grapple with this. You say 100, okay, you say equal sign, and you say 100, okay, divided by 130, and then I think you can close the brackets, there's nothing wrong with that, and then you multiply that by 7/8. You will really be finding a 6,000. So when you do the summation, you find that the actual closing inventory was something wrong with my computer now. The actual closing inventory was 36 or 39. Oh, come on. 39,300. So the difference between the 39 and this 36 is you know, let's try to check, minus that, I'm getting 33. Okay, so that 33, it should be less, all right, from stock, because it appears that closing inventory was understated. The understatement of closing inventory means that the cost of sales was overstated. So what you do, you're going to less that 33 from that amount, and by the way, you can still find just a simple difference between 6,000 and 27. You still get a 33. So if we do the summation now, we will find out that our cost of sales is standing at that much. Okay, all right, then there's another working that I'll need to do before I sign off: the issue of tax. The issue of tax. Okay, so I think last time I showed you how to deal with tax, but I'm doing it again because we want to, you know, jokingly save your exam fees. We don't want you to get back to this class. So what you do, you have to handle the estimate, bring in the estimate, and bring in the over provision. I think I saw an over provision. Tax on the credit side of the trial balance is an over provision from the trial balance there, and then check for movement in deferred tax. Okay, so we are going to go to the note very soon, but let's start there. We are told that Highwood, not this one, but which note is that? Note 4. Yes, not 4. Current tax represents the under over provision for the year. Now let's go and check what is happening in the trial balance. Where is your tax? Your tax is on the credit, meaning that it's an over provision. So you come here and you say minus. So over provisions you less. And then you come back to the note. What is the estimate of the bosses, the directors? The directors are saying the required provision for income tax for March 2011 is 19.4. So you go and put it where it belongs. This is the estimate, 19.4. And then movement on deferred tax, we need to be a little bit careful. We need to be a bit careful. Movement on deferred tax. So we are told that Highwood received a delivery, not that one, on not that note. We are told that the difference between the carrying amounts, the assets of Highwood, including the property revaluation in note 3 above, and their lower tax base is 27 million. Highwood rates of income tax is that much. So who is this? We're going to find 25% of 27 million and call that one as closing deferred tax, but we have to remove the deferred tax relating to the revaluation. So let's do some bit of work. Some side working. I'm just showing you something here. 27 million multiplied by 25%. I've got 750 less the amount that was brought forward, or that let's first of all go to the revaluation. Whenever you value an asset, the revaluation surplus attracts, you know, tax. So in our case, we needed to do some bit of tax competition there on the revaluation, but I think I can get there later. Let me deal with the brought forward deferred tax. How much is in my trial balance? Time is not our good friend. It's a 2.6. So I go there and I say, let us remove the 2.6 from. Let us remove the 2.6 from that amount, and then further on we're going to have to find the revaluation surplus. So remember, the asset was valued at 80,000, but at that date, what was the CV? We are told according to trial balance there, the CV of the asset stood at 75,000 less 10,000. That is obviously 65,000. So what we're going to do, we're going to say 65,000. This is for property, mind you. What's the difference between these two figures? I'm sure you can see it's a 15,000, and this 15,000 attracts deferred tax at 25%. So we're going to multiply the 15,000, say deferred tax is equal to 15,000 multiplied by that much. I've got that figure there, 3750. So that 3750 also comes off. We say 3750. So the movement in deferred tax, the deferred tax to be put in the profit or loss, will be 750. If I may do that, 750 minus 26 minus 3750. All right, time not allowing, there's a 400 there. Great. So that is still an increase in deferred tax, so that our tax obligation will be in 19,000. This is what I want to see in the profit or loss. We need not to forget that. Then the issue of 3750 must be dealt with in OCI. So under OCI, your revaluation surplus will be 15,000 minus 3750, which of course is as good as what you can see on the screen there. This is the figure that you're supposed to take to your OCI, other comprehensive income, as well as the statement of changes in equity. So I think I've done my bit. You need to go ahead and do the statements. So thank you very much. I hope that we can have a fruitful discussion on the other side. Thank you.